We're going to talk about understanding the different financing options today. Okay. Understanding the different financing options. Okay. Evaluating and selecting the best financing option for you. Every real estate deal has its own way of getting financed. Everyone. This is a real estate investing course. So, yes, you can come out of pocket 20%. You can. A lot of these deals, you don't have to. Build your team together. There's enough investors, hard money, private money. There's enough. And my goal, my dream for all of y'all, even those watching a replay later on, is that you understand how to use your team to your benefit. You understand how to use these financing options to your benefit. And now your job is to look for the right deals that cover your spreads. That way your investors, your lenders can get taken care of. The property can cash flow. You can cash out refi later on or let it sit and pull from the equity that goes on your, there's a lot you can do on your own. We're going to focus on one, because I said this in first class. Your first property should be your homestead, should be your first investment property. Now, that is a controversial term. I'm not a controversial person. I think we need to have our own house. You learn how to invest with your own house. I'm a fan of house hacking, meaning get a duplex, get a triplex or a fourplex, depending on where you live. FHA allows you to do that. You can lease out the other three and stay in one. That's the perfect storm. Do it over and over again if you can. If you personally can't, pull somebody in on the family. If our kids are getting older, let them have that investor mindset. This is an investor class. I always have an investor mindset. Everything I do is ROI. I may not want to live that lifestyle now, but I like what that lifestyle will give me later on. And that's what you want to start thinking about now. Understanding the mortgage process and how to get approved. We will go through that today. Now, real estate financing. And again, this will be in the chat, in the study hall. And this class is over, so y'all can have it. Real estate financing options. You got your traditional mortgage, right? Your conventional X percentage down, your FHAs, your things of that nature, right? Your regular, I'm a person, W-2 or 1099, whatever. You bring your documents to the table, to the lender, and the lender approves you based on your credit score, debt to income ratio, Okay, traditional stuff. You can do an investment property with a conventional loan, put down a certain amount depending on the bank, the institution, and go from there, right? You live in your main house, right? 123 Main Street. I live here. This is my house. This is one person house. I want to go out and get a second property, an investment property. Okay, depending on the lender, you put down X amount, they'll fund you. Okay, do that. That's traditional. Hard money is another thing. Private money loans is another thing, and seller financing is a whole nother thing. Okay. I'm going to go back and forth within these PowerPoint slides to show you, here's the four, here's the pros and cons of traditional. So let's go here first. And y'all ride with me for a little bit. I'm going to start jumping into the links, because if y'all don't know me by now, I'm a big fan of having links, because I don't want to be the one to, I want you to take coach's advice. So coach said, do this. No. Coach said it, but you can go and resource it here. And I want y'all to learn that as investors too. Just because you hear somebody say something about real estate, don't start, oh, he dropping gems. Well, okay, well, how you know that? This is an investment course. I think EYL is okay with me saying this. Just because somebody says it and it sounds good, go research what they said. And based on that source data, and if that's industry standard, okay. Because there's nothing new under the sun in this real estate game. This real estate game is nothing new, is nothing fancy. Look, nothing. Zero new about it. There's no way to finesse it. Nothing about it. The better you get, the more deals you do. And the more deals that you do, the better you get. That's kind of how this thing works. That's it. Pros about it, right? Traditional mortgages do have lower interest rates than hard money or private. They're longer term, 15 to 30-year terms. You can be easier to qualify for good credit and steady income. Pay attention to that good credit, steady income part. They want consistency. They're going to give you a loan for 15 to 30 years. They want to make sure you're going to be around for a minute. All right. The cons here typically require a larger down payment, often 20%. Again, this is your traditional mortgages. We go into the FHA programs. Links are in study hall from last week's class. I forgot who put it up, but she's like, I'm not good with names, but the young lady who put the notes up from last week's class, please remind me, because you're going to be what saw from my last class as far as student of the week. I got to get your name down. She put all the notes from last week. I'm like, God, you took all the notes for real. So shout out to her. Typically require a larger down payment unless it's FHA, longer application and approval process. When it means longer, y'all, longer than your normal investment stuff. Most investment lending, they lend based on the deal and not really your credit. So if I'm going hard money, private money, or seller finance, it's more on the deal structure and how the deal pays out and how you can handle the deal based on if your FICO score is good or not. Okay. More stringent credit and income requirements. It is. It's a traditional mortgage. It is what it is. Okay. Hard money. Hard money, hard money, hard money. Let me go to this. Let me see if I got my link real quick. Because I like to give y'all good sauce for sure. How do we get the study hall? I think she's got it. Okay, cool. Just checking out the let's see. Now, hard money. Y'all know I love Investopedia. I'm gonna pull it down every day of the week. Using hard money loans for real estate investments. I'm gonna put this link in the chat. If you can put the link in the chat, appreciate you. Appreciate you. Shout out to the EYLU administrator up there doing her thing. Appreciate you, sis. Real estate investing can be a lucrative avenue. It can be. It is if you do it right. For building wealth. Okay. Crowdfunding, real estate trust. But let's talk about the money. How hard money loans work. Hold on, some of that. My computer acting up. How hard money loans work. Hard money is sometimes referred to as a bridge loan or short-term lending instrument that real estate investors can use to finance an investment project. Investment project. Write that down. This type of loan is often a tool for house flippers. Best thing out there. Or real estate developers whose goal is to renovate or develop a property, then sell it for a profit. Hard money loans are issued by private lenders rather than mainstream financial institutions such as banks. Don't miss that. You're not going to get a hard money loan from a bank. You're going to get it from a private person. Unlike traditional bank loans, the ability to obtain hard money financing isn't determined by the borrower's credit worthiness. Instead, hard money lenders use the value of the property itself to determine whether to make the loan, the deal. I'm going to let you go through the cons and pros. Investopedia are very well vetted. Great like source. I like this link in particular. Okay. I like that link in particular. Fire. If I'm doing any kind of flip, I got my hard money staff. Now, last class, what I tell you got to get? Realtor who has the team around them, general contractor, trades. If the realtor's doing flips already, go walk their property. That person who does those flips has a lender, trust me, and they don't mind giving them up to you. That's not like somebody, oh, I don't want my lender. And if they do, don't even worry about it. If people are tripping that bad, don't trip. It's not that big a deal. People have lenders. They should have a team, general contractors. They should have a title company and a slew of folks that they go to for their loans.